Hey, I'm Scott, and welcome to Talk Stocks with Scott. Some people just want to make friends. I just want to make money. That's right, people. Let's make you some money. My job is not to entertain you. No, people, not at all. But to educate you. So call me to Talk Stocks with Scott. Today is all about investing in companies. The bottom line is, up-and-coming companies and existing ones need to be thinking about the driver of a firm's profitability. Now, how would a firm go about this? Well, first and foremost, they must maximize the value of the firm. The point of any organization is to give back to its shareholders. And that's the bottom line, folks. If they can't give back to you, the people who invested in them, and risk their money for them, you may need to think twice. That's right, twice before you act. To begin, everyone, and I'm talking about the globe here, should know that their starting point is how well management is using the funds invested by the shareholders and owners to generate returns. How do you do this? Well, you need to look at the return on assets and financial leverage. This means you're looking at net income, total assets, and owner's equity. Keep in mind that assets are used to generate income, which goes to the owners and shareholders. And that's the return on assets part. The financial leverage part is a measure of how much the assets are funded by the owners. That means they're not funded by creditors. Funding by creditors equals debt, and that's not good. Looks like we have a phone call on line 3. Caller, you're on. Let's make you some money.
Hi Scott, love the show. This is Jenna and I work for Bruce Nordstrom. He is always talking about COGS and costs. Why do they matter so much?
Well, Jenna, you can work for me anytime. Call me. Oh, well, anyway, COGS stand for the cost of goods sold. This is the annual expense or cost of all the inventory actually sold. And if you take this and divide it by the inventory, it is a measure of how frequently, on average, inventory is sold in the year. The faster you turn it over, the better you are. And since you work in retail, your COGS are going to be the main expense. The decisions regarding the purchasing and management of inventory is going to heavily impact net income. And that, my dear, is the reason why your Brucey is so concerned with COGS and costs.
Thanks so much, Scott. I'm going to blow them away at the next meeting. And now I don't have to wear those low-cut shirts anymore.
Okay. Let's get some intelligent conversation going here. Man, I am fired up. Maybe it's the market. Maybe it's that feeling that the Apple Cup rally gave me before the second half. I just don't know. Oh, but wait. It's really for the lightning round. Just to be clear, I don't know the names of the callers. I do not know the stock ahead of time. This is about brilliance, folks. Are you ready for the magic? Britnee from Washington. Give it to me.
Hey Scott, what about Baldwin? Is it a quality stock? Buy or no buy?
Wow. I'm going to have to give you a student discount on this one. I give you time on my show and you come up with Baldwin? Baldwin, that bear? I would come back to you and say Digby. You want to buy Digby because the stock with the most consistent growth over the last 2 periods with the lowest price per share. While Baldwin, that grizzly stock, stays flat. Next caller, Katie from New York. Hit me.
Hi, this is Katie from New York.
I thought it was you, Katie. What do you have?
Well, I really like your new book. The stock that I have a question on is Erie. It had a great run for the first couple of quarters, but then it had a tumble. It's come back in the 4th quarter, and I don't know if I should keep it or walk away.
In Scott stocks, we don't care where it's been, just where it's going. Erie has been one of my personal nightmares over the last quarters. But you know what I think? That nightmare's about to be over. Because we're at the beginning of an electronic sensor rally that Erie is going to lead the way in. They had some issues after developing a product that actually never came out to market. God bless China for their help in that matter. But after much diligence, they zoned in on their segment market and continue to modify their products to maximize their firm value and increase their stock worth. So buy, 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 give them the horns, and hold on for the long haul. Patty from South Dakota, let's hear it.
Hey Scott, I'm calling because you gave me a faulty prediction that Andrews would show tremendous growth in the fourth quarter. But rather than tremendous growth, it was a measly 88 cents. What do you have to say for yourself?
Did you also take time to look at the profit of over $4 million? A contribution margin of 34.6%? And an increase of 88 cents per share over 2 million shares that gives them over $1.7 million in market value? So here at Scott Stocks, we don't go for short-term gain, we go for long-term profit. So I say, buy, 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 hold out, and watch the magic happen. And that, folks, is the end of the lightning round. And thus, the end of the show. So remember, when you invest in a company, pay attention to the ROE, the push on management, on behalf of firm value. Investing well isn't easy, but it's possible. This has been another enlightening experience with Scott Stocks. Get money, people.
That was good. Hey, let's take calls. Let's go to Kyle in Rhode Island. Kyle.
Hey, Jim, I got a gentleman farmer booyah for you.
Nice regional booyah. What's up?
Hey, I remember you mentioned Healy as a hot upcoming IPO, and it got me thinking. It's tough sometimes for individual investors to get IPO shares.
Oh, yeah.
But what
The good ones. They'll give you all the bad ones you want, because you know why? They could give a darn about the individual. That's a little Marxist. Go ahead.
So I was thinking, what do you think about buying IPO underwriters as pin action?
Well, I think you got to be careful because most of the underwriters aren't nearly as levered to the IPO market. I might look at the new KBW. They bring a lot of the boutique savings and loans and banks. That has that kind of action. But for the most part, when you buy a Bear Stearns or a Lehman Brothers or a Goldman Sachs, which I like on fractionalersplus.com, you're buying a whole pastiche of businesses. And so I don't think you can necessarily talk about IPOs. But the new one, KBW, may be the one for you if that's where you want to go.